Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Canada has entered negotiations to buy Saab's Global Eye aircraft. The advanced aerial surveillance system is developed in Sweden and will use Canadian-made jets. Speaking at the CanSec Defense Show in Ottawa, Prime Minister Mark Carney said the federal government is negotiating a deal that would see at least one-third of the projected fleet manufactured in Canada over the next 15 years will be by Bombardier. He says a deal would position Canada as an integral part of the global supply chain.
Saab and Bombardier's expertise is transforming a modern jet into a cutting-edge surveillance aircraft with altitudes of over 30,000 feet. The Global Eye partnership will establish Canadian-based production capability, including aircraft conversion and missionization, engineering collaboration, R&D, and potential participation in radar component production, positioning Canada as an integral part of the Global Eye global supply chain.
Shares of Scotiabank are edging higher today. That is after profit was up today in the latest quarter, beat estimates thanks to strength to its Canadian banking division. It also announced an increase to its quarterly dividend. Looking ahead, Scotia says it expects to see earnings increase by double digits as it works to cut costs. On the downside, the lenders' provision for credit losses, they were higher than expected. Shares of Lululemon are rallying. The retailer says it has reached an agreement to end its feud with founder and largest individual shareholder Chip Wilson. The company agrees to appoint two of Wilson's nominees to the board. A product and brand expert will also be appointed. In exchange, Wilson agrees not to criticize the company in public or private for 18 months. And a quick look at the markets. TSX down by about 0.22%, slowly trying to turn it around. It was off a little more than that, but still hovering around record highs. No real complaints, I think, for most people. Tech leading the way and dragging people down. Energy and materials right now. U.S. markets, you can see a mixed bag there. The Dow Jones, the only one in the green. The S&P 500 pretty much a wash, and the Nasdaq is off by a quarter. Well, Canadian bank stocks are mixed this morning after the Bank of Montreal, National Bank, and Scotia posted their second quarter earnings. Joining us now is Mike Vinokur, portfolio manager and senior wealth advisor at Propellus Wealth Partners with IA Private Wealth. Mike, thanks as always for joining us.
Thanks for having me.
Okay, we're in the middle of the banks, half reporting right now, or the big ones. What initial reaction to what you're seeing, just overall for them?
Overall, no huge surprises. We expected that earnings would come in quite strong, especially because of the reduction in credit provisioning potential. And as we saw, the three banks reported, BMO, Scotiabank, and National Bank, and capital is good, ROEs are good. Earnings are up. So there are no real blemishes that I think anyone can point to.
All right, let's talk about Scotiabank off the top. We'll start with them first. And some of the strengths from today. What stands out for you?
Well, Scotiabank was actually the one that we thought maybe was good, but left a lot to be desired. Specifically, it seemed to us that based on the earnings report, the Canadian bank earnings were strong, but they were strong because provisioning was down a lot. So that really propped up earnings, made cost cuts. The international divisions didn't really contribute that much. Wealth management earnings were up, but that's mostly on account of markets being very strong. the CET capital ratio, which, talks about capital strength, is, 13.3%, ROE's 13.2, they're targeting 14. So nothing really to point out and say, oh my God, it was bad. No, it was decent. But I think they have some more work to be done. And an interesting note here is that in the past, Scotiabank was always trading at a premium to the Canadian banks because I think the market always thought, international markets grow faster than domestic markets. Therefore, maybe we should assign a premium on a price to earnings multiple basis on a forward basis. But here we see that the stock, even with today's action, is trading at approximately 11 times forward earnings, whereas BMO and National Bank are actually trading higher than that. So maybe now international, i.e. Latin America, is not as exciting for market participants.
Do you see them pulling back further from international?
Not quite sure. I do know that they made a big foray in the U.S. market with a big equity stake in Key Bank, I believe it is. And so, Mr. Thompson is obviously foreshadowing that the North American market is where he probably wants to concentrate the bank's capital. He has been pruning back a lot of the international exposure, but I do think that there's some really good franchises that they own in Latin America and in the Caribbean, and you would think that those markets can grow at a much higher clip than what we've got here in Canada and maybe even in the U.S.
All right, let's move to BMO. And would you call this the strongest for the day, or is it national, do you think?
No, I would say BMO. So BMO, I thought, reported some pretty outstanding numbers, especially in the U.S. So I think it was a couple years ago, BMO bought, I believe it was Bank of the West. And at the time, they had a few quarters that went by. They were promising synergies. The synergies were kind of happening, but it was taking a long time. I think they've really done a bang-up job here because, U.S. banking and wealth management were the clear winners this quarter, up 32% and 34% earnings revenue growth. The Canadian division did not fare nearly as well. But having said that, on a valuation, and by the way, the capital is very solid at 13%. ROE was good at 13%. But the bank is now trading at 13 and a half times forward earnings, and the stock has been on a huge tear in the last 12 months.
All right, and we're getting tight for time. I want to get in National Bank as well. And I get the sixth, and it kind of gets lost a little bit, but solid numbers?
Yeah, pretty solid numbers. I mean, National Bank, as the quote-unquote baby of the Big Six, has in the last 5 or 10 years been able to escalate their growth. I mean, earnings were up 18%. Pretty much across the board. ROE was very good at 16.8%, so that's a very good number. Solid capital base at 13.5%, but again, a 2.5% dividend yield now, and trading at close to 15 times earnings. These are not cheap valuations anymore. Nothing bad to say about the enterprise itself, just specifically saying that, from a valuation perspective, when you're looking at companies that are levered 10 to 1, you have to be careful of the valuation and the multiples that you're paying.
And just looking ahead, what are you expecting from the other three?
Again, same as the first three. We wouldn't be surprised that earnings come out great, but I would caution people that, the stocks in the Canadian banks have run up quite tremendously. It used to be that the Canadian banks would pay a 4.5, 5% dividend yield and, have some capital growth. Those dividend yields have fallen because even though the banks keep raising the dividends, the stock price appreciation has been much more rapid than they can, raise their dividends and still keep them under a, call it 50% payout ratio to earnings. And so again, I think you need to temper your enthusiasm on the group strictly on a valuation call having nothing to do with the execution of the businesses themselves.
All right, Mike, we have to wrap it up there, but thanks as always. Always great to chat with you.
Pleasure. Thanks for having me.
Mike Vinokur, Portfolio Manager and Senior Wealth Advisor at Propelus Wealth Partners with IA Private Wealth. Well, shares of Abercrombie are rallying this morning. Our next guest says the results were better than analysts were fearing. I'll tell you what that actually means. We'll get more after the break. Shares of Abercrombie are up sharply this morning after results came in better than analysts feared. While shares are rising, Abercrombie is still down more than 30% since the start of the year. Let's get more now from Dylan Carden, consumer research analyst at William Blair. Dylan, thanks very much for joining us.
Thanks for having me.
Okay, so better than what analysts had feared. Is that good?
On the day, sure, right? I mean, look at the stock reaction currently. I mean, a lot of what we're doing here around earnings is sort of an exercise in trying to read the tea leaves and intra-quarter data, some of which you guys put out directly through your alt data. The read for Abercrombie brand suggested that it was going to have a prolonged recovery, and Hollister continues to get worse. So I think a lot of the expectation was, particularly on the Abercrombie side, a comp that was going to be negative as opposed to flat, and Hollister, I think, did a little bit better, at -2.
Now, and are they trending in the right direction, does it feel like?
I would say no for Hollister. Abercrombie is encouraging, right? I mean, part of the issue here is just visibility, right? I think we're all longing for a period where we can just sort of put a consistent low single-digit comp in our model, have some visibility into store growth and kind of be done with it, right? Know what the right margin to put in our models is and sort of get past this period of volatility.
Now, one of the things you put in your notes about the SG&A, the deleverage worse than expected, how much of a concern is that?
So the whole issue is that, like many companies coming out of the pandemic and sort of higher inflection and from a comp standpoint and a growth standpoint, Abercrombie was over-earning there for 2 years, right? So they put their operating margin in and around sort of 15%. And so last year and sort of the front part of this year has been an exercise in slow walking down margins, right? And so anytime you're seeing cracks and profitability, in this case, and around sort of the SG&A deleverage, because gross margin is a very noisy metric right now around tariffs, and actually Abercrombie's seeing benefits to freight costs in their gross margin. So you're looking for just sort of reads on, where profitability ultimately trends to. Our concern is that if you look at what management has said sort of historically and sort of the broader industry average, you could be looking at an op margin on this business in and around 10, 11% versus you're still kind of hoping for 12 to 12.5, right? So how you get there, it's kind of on us. Management isn't really doing much to sort of guide you down at this point.
And are they working on their SG&A, or is it does it look like it's only going to get worse?
I mean, the body language is sort of muted as far as the puts and takes on margin in the back half. Taking gross margin aside, on the SG&A line, they're talking about maybe some modest marketing leverage. But by the same token, they're talking about investing back in the business. They've ramped some of their store growth, which is sort of margin dilutive from an SG&A standpoint. So probably more of the same would be my thought go forward.
All right, and you mentioned about tariffs. They're actually seeing benefits from the tariffs or from the freight. How are they benefiting?
It's contracts that were locked in prior to these prices spiking. Once they have to start renewing those contracts later in the year, you're going to see it turn into a headwind. Tariffs are actually a tailwind in that, they're now modeling out 15%, whereas you're going up against the IEEPA tariff rates, which were, at times higher. So that actually becomes a modest benefit as well, or at least less of a headwind.
And when they have to renegotiate those, how much of a headwind does it become? On
the freight side,
on the freight
side. Yeah. I mean, where's your oil estimate in a month? Probably 100 or so basis points if you're just going to put a gun to my head.
I don't want to do that. But still, no matter how you slice it, it's going to turn into a headwind at some point. Where are they going next then? What do you see happening for them for the next year?
The stabilization of both brands, right? I mean, Abercrombie was comping over a 20+% comp, and now Hollister's comping over a similar comp. They're on about a 6 to 9 month lag against each other. I think there are some real embedded positives in the way that they approach inventory, speed to market. I think there's a lot of efficiencies now to be had in marketing in particular, particularly on the digital side. So, again, what you really are playing for here, I think, is just some stability, some visibility. If you look at what's being rewarded in the market, it's 7.5 times forward PE on this name. I think that, maybe 8 to 12 would be your historic range. A lot of that just reflects lack of visibility. What's my margin for next year, right? So I would hope that kind of exiting this year, you're looking at kind of a low single-digit comp on both brands. We've got some line of sight into what the store growth should be, the dilutive effect of marketing. Then, we can put in something in the out year, 27, 28, that we can feel good about and start talking about maybe, valuation being too low. I think it's just too early for that.
And bigger picture for the industry, headwinds or tailwinds ahead for them?
Yeah, I think we're just desperate for a unified view of the consumer, and there's just none to be had. You're seeing real, I think, sensitivities around inflation. I don't think that's a controversial view, right? But as far as where there are pockets of weakness, I think it sort of boils down to who's taken aggressive price in recent years, right? Restaurants, luxury. So I think the biggest headwind for everyone in the back half is just going to be how much more you can push through pricing. Or do you actually start having to be, start taking down your price? Look at Kroger, what Kroger did the other day, right? And sort of broad stroke deflation. Apparel and most discretionary categories historically been deflationary, right? So you're talking about aggressive price taking in the last year of 10, 15% in a category that's had no pricing power historically going back to the 1990s, right? So I think that's really, particularly as this drags on, this being sort of broader negative sentiment in an election year, in a midterm year, right, which tends to sort of crowd out marketing spend, it could get choppy here for sure.
And does Abercrombie have room to compete with that, like dealing with the deflation?
I don't know if anyone does, truthfully. If you start having to take down price or promoting more, which you're seeing sort of early green shoots of that, or early signs of that, particularly in the Hollister brand, though they push back on that. No, I think you're sort of seeing some cracks there emerge. I don't think any real brand has capacity, with few exceptions as far as sort of streaming brands.
Okay, Dylan, we got to wrap it up there, but thanks very much for joining us.
Yeah, thank you.
Dylan Carden, consumer research analyst at William Blair. Coming up, today's market drivers with Bloomberg's Monique Molina. Time to take a look at today's market movers, and we are joined by Bloomberg Equities reporter Monique Molina. Monique, thanks as always for joining us, and let's get right to it. FedEx on the rise.
Yes, so FedEx, their shares are going higher this morning after they were upgraded at JP Morgan. The company is set to spin off its freight business as of June 1st, and analysts are really positive on this. They think the remaining company, FedEx, will be able to trade at a premium because of its free cash flow, because of the operational momentum, and they see it as more attractive now with the freight business spun off. But they do note that the standalone freight business might have a little more weakness in comparison. All right, GXO Logistics, where are they going? Yes, so GXO, they are also higher this morning. They were upgraded at Barclays. The analysts are positive on the stock as seeing it as more attractive now. There has been some recent underperformance, but that's been largely due to lower consumer sentiment because of the Middle East war and also due to Amazon's entrance into logistics. But they know that GXO is improving on their margins, they're improving on their operations, so they do see the company being able to compete more going forward. And they say that with these lower stock prices right now, it's a good time to get in before they see some of that growth. All right, and with everything that's unfolding in the Middle East, hopefully continuing a good direction, energy stocks taking a hit? Yes, so the energy stocks are lower after oil prices fell about 5% this morning. That's weighing on some of the oil majors like Chevron and Exxon. And analysts note that this is largely due to the fact that traders are starting to price in the potential for the Strait of Hormuz to open back up. Some are starting to sell out of oil now that they think that this is a possibility that the U.S. and Iran could reach a deal soon, while others are just trying to price how soon oil would actually be able to come back flowing through the Strait of Hormuz, especially for some of the producers in the Middle East that had halted operations. This isn't necessarily going to be something that is right away, but in the meantime, people are selling out of some of these stocks.
And airline stocks, I'm going to guess they might be going the other way.
Yes, exactly. So the airline stocks, they are trading higher this morning. TD analysts said that they're now more bullish on the U.S. major airlines like United and Delta and American Airlines now that the fuel prices are coming down. With the fall in oil prices, that directly translates to lower fuel prices, which is a large cost input for airlines. So we're seeing a lot of positive momentum on those stocks on the prospects of oil continuing to go lower.
All right, we'll wrap it up there. Monique, thank you as always for joining us. Bloomberg's Monique Malima. Up next, what's driving Brookfield Renewable Partners right now and why it's catching investors' attention. Prime Minister Mark Carney says Canada has entered into negotiations to buy Saab's Global Eye early warning and control aircraft. He says the aircraft will be built on Bombardier's 6500 plane, and they are Canadian-made with 20% U.S. content. Canada had been considering bids by U.S. firms for the contract. Carney says the Global Eye will be a key resource for the Canadian Armed Forces to detect and deter threats across the Arctic. Bank of Montreal top profit estimates in the second quarter on robust fee revenue across capital markets and wealth management. Global markets and corporate banking were also up significantly from a year earlier. The bank increased its quarterly dividend by 4 cents a share. BMO's provisions for loan losses were lower than expected. Shares of Target are moving higher after the company said it's aiming to improve workers' customer service skills. Employees will be tested on how they greet, help, and engage with shoppers in an effort to make service more consistent across stores. Target says that elevating store experiences is one of its top priorities. The move comes as the company hopes to turn around years of sliding sales. And a quick look at the markets, and TSX trying to claw its way back. It's down by about 0.2%. South of the border, a little bit of a mix as well. Mostly red, though. You can see S&P 500 off by 0.1, and the NASDAQ off by about a quarter point. Earlier on our On the Radar segment, where we highlight stocks, commodities, and market-moving stories grabbing investors' attention, we were joined by Colin Stewart, CEO and portfolio manager at J.C. Clark, to break down what he's watching right now. We kick things off with Brookfield Renewable Partners.
We've owned Brookfield Renewable for quite a while. They're one of the leading, not just Canadian, but global renewable companies. They've got a broad portfolio of hydroelectric assets, solar, wind, energy storage, battery storage, which is becoming an increasingly important part of their business. And, like many other of these sort of AI peripheral businesses, I would say they're really seeing a benefit because as we've all read, there's a huge increase in the demand for electricity and power, and driven by the sort of huge power consumption of these AI data centers, which is leading to a supply deficit. And that is ultimately creating a situation where renewable companies like Brookfield have strong pricing power and are able to actually enter into, if anything, becoming better businesses because they're entering into these long-term PPA agreements with leading tech companies who are willing to pay higher prices to sort of secure.
Just to guarantee they've got something.
To guarantee. And I think it was one of the first ones they did a number of months back was with Microsoft. It was like a 10-year plus deal where they locked in at very good pricing. And so, and I think the other thing is a lot of these tech companies do the idea of using more renewables to power their data centers.
It felt like it got lost a little for a while, renewables and green, especially green at like the windmills and things like that. But is it coming? Is it coming back? Are people starting to turn to it again?
It is a bit, and I mean, I think it's just coming back because there's just so much demand for power. And a lot of this tech ecosystem. I think there's a concern that there's criticism if they're using too much power for the data centers and it's not clean power. That they don't like the PR around that. So there is I think an increasing need for both reliable power and using renewable power. And Brookfield is perfectly positioned to do that because they've got significant access to capital, have been in the renewable business for a long time. I think they're very well positioned to strike more of these type of long-term power purchase agreements with the tech companies like a Microsoft that I mentioned. And beyond that, I mean, one of the things we've seen as an investor is if you want to play the AI theme directly, you often have to pay a very high price to buy a tech stock in the U.S. But the nice thing is Brookfield Renewable is a very profitable business, generates great cash flow, pays a 4.5% dividend yield, and only trades at about 14 times EBITDA. So it's something as we're sort of more value-oriented investors, you can get your head around. It's a good business, generates cash flow, been around for a long time. It's not some upstart that is losing money. So I think for a Canadian investor as a way to buy a reliable business that has, really good supply-demand dynamics over the next decade and trades at a reasonable multiple, it's a good one.
All right, and I love this next one because it's just something you probably wouldn't think of. Black Diamond, modular space solutions and workforce accommodations.
Yeah, so it's they've got sort of two businesses, and the I'll get to the second one, the workforce business, in a second. It's sort of the old camps business where they did set up camps for these oil sands companies, and it hasn't been doing super well recently because the big oil sands projects have not been a focus for the last while. But this modular space solution, I mean, just think of it as, if you drive down the street and there's someone's building a bridge or fixing a road, there's often a trailer on the side of the road, and the construction company is renting that trailer from someone like Black Diamond, and they get a rental rate. So it's a very reliable cash flow producing business. And this is a North American business. They have these trailers all over the place on construction sites, infrastructure projects. They even provide portables for the education sector in the U.S., which is a growing area because there's a sort of shortage of new room for schools to expand. So they often have these portables on site, and they get a very stable rental rate. They're able to raise pricing. So it's been a very good business. And now, as we're thinking of data centers being built, these massive construction projects, they need offices, meeting places for workers, washrooms, things like that. And Black Diamond is in the business of providing that. So they're actually getting a tailwind from the data center side of the business as well. And then if we go to the workforce side, where that old oil sands camp business has been, running at a very low capacity utilization. Only about 50% of their assets have been utilized. But now what's happening because of this huge infrastructure push in Canada, development of the North, Arctic development, resource
increasing
projects.
Oil production.
Yeah, increasing resource production. These camps are starting to be needed, these camp assets, and they're sort of, again, modular. They can move these accommodations around. They actually bought a business recently that does catering as well, so they can offer that. And just think as these, new military bases get built, new mines get developed, LNG facilities, this massive theme around the development of Canada's North is really going to benefit this business because these workers, and even their data centers getting built in some of these more remote regions, and the workers are going to need a place to stay. And all that being said, Black Diamond's a really well-run business, solid management, and only trades at an 8 times multiple of cash flow. So we think the outlook is very bright.
All right, let's get the last one in here. Exchange Income Corporation.
Yeah, this is, again, a company that's been around out of Winnipeg for a long time. It's sort of a bit of a diversified industrial company, but 85% of their business is really in one division that's called aviation and aerospace, and it does 2 key things. One is that they've got the dominant sort of almost monopolistic type of position in an airline to the north in Canada. So they do passenger airline to the north, freight, charter, and obviously with the development of the north, you'll have a lot more people going up there. So that's very positive for them. And then they've got another business that is called in the ISR business. It's basically intelligence, surveillance, and reconnaissance. So for different countries wanting to monitor their borders, their marine borders, land borders.
Our north, exactly.
Exchange Income is perfectly positioned around that. Pays a great dividend, which has increased, I think 25 times over the last 20 years. Well run, and all that being said, it's a sort of a way to get exposure to the aerospace and defense sector. But again, it only trades at about 9 times EBITDA, so it's not a demanding multiple, and it's a nice way to sort of for Canadian investors to back into this defense aerospace theme at a reasonable price.
And even with the surge it's seen over the last year, and it's
yeah, I mean the multiple is still cheap compared to U.S. defense companies trade at 15, 16, 17 times EBITDA, and I think the huge spend we're seeing here in Canada to bring the targets up on defense spending as a percent of GDP is really going to benefit the whole sector in Canada. And I think exchange income is one of the cheaper ways to play that theme.
That was Colin Stewart, CEO and portfolio manager at JC Clark Limited. Up next, we take a look at a brand new approach to navigation and how that might be helping Canada's space sovereignty ambitions. Zona is a navigation infrastructure company with an aim to build Canada's spacecraft manufacturing capabilities. Today, they announced a collaboration to unveil a new approach to distributing UTC, Canada's official time standard. Let's bring in Tyler Reid, co-founder and CTO of Zona, to learn more on this. And Tyler, thanks very much for joining us.
Well, thanks for having me. It's a pleasure to be here.
Okay, this new collaboration is with the National Research Council. What exactly does that mean? What will you be doing?
At Zona, we're really working to deploy the first commercially owned and operated satellite navigation system. So today, when you pull out your phone, I think our experience with GPS satellite navigation is that it gives us the blue dot that tells us where we are in the world. But GPS does a lot more than that. Specifically, it's the timing support for all of our critical infrastructure, the things that we don't see. And so this project is about, how can a commercial system distribute timing to places that were otherwise harder to do in the past.
And so how are you doing that? What can you change? That aren't the clocks we use, the atomic clocks, accurate to I don't know, I want to say a billionth of a second or something like that, or?
That's exactly right. So today GPS is that kind of unseen infrastructure layer that does so much more than just tells us the location on your phone. And so when we're talking about time transfer, GPS fundamentally is a time transfer system. So it's a bunch of radios in the sky that we measure distances to give us our location. And to do that, you need to get that down to a billionth of a second. You have it exactly right. And the reason a billionth of a second is that turns out to be about a foot of error. And so the system being positioning and timing are kind of all the same thing from the perspective of GPS. And so from a commercial systems perspective, really what's different here is that, traditionally, this is a government system. So in the case of GPS, when you pull out your phone, you're connecting to U.S. Air Force satellites. And so we're really building the first commercially owned and operated satellite navigation system, which gives the opportunity, in the case of Canada, to deliver Canada's source of time to places like the Arctic and to the critical infrastructure that supports Canada.
Why is it important that we use a Canadian government-based time rather than the Americans?
I think we're in an era of resiliency. And so having access to more sources of time is critically important. And the reason for that is, we've seen in the world GPS become not something that we can rely on. More and more we have conflicts in the world that are denying GPS in certain regions of the world. So we see this in places like Ukraine. We're in conflict zones. We have the source of time and positioning from GPS being jammed out across the country. We see that being spilled out into mainland Europe, especially, where now you see that affecting things like the civilian world in terms of commercial aviation, where air routes are denied GPS or have to change their routes and it has impacts on safety. We see the same thing happening in terms of the maritime market, where most recently we see in the Strait of Hormuz, we see widespread GPS jamming, denying GPS to the maritime sector. So we're seeing more and more kind of folks looking for alternatives to GPS because of these issues that are arising in the world to have that source of resilience. And so this is just one more source of resilience that gives access to that in the case of Canada specifically.
And are there any issues? It's an American company and then Canadian offices, I'm guessing. Are there any issues or concerns with that? Any conflicts?
So we're building really a global commercial system. And so we're building a system that allows to tie into multiple sources of time. We've already announced an agreement in the UK with the National Physical Lab. We're working, of course, to deliver time standards that are also aligned with the GPS time standards in the US. And so this is really a global infrastructure that's meant to service multiple markets to bring resilience really across the board.
And you're also working with the federal government on, is it Pulsar? And what's the latest? That's a separate one, if I'm not mistaken, right? Pulsar is a separate one. I'm not misunderstanding that.
You're exactly right. Pulsar is the sort of generic name for our commercial service. So this is building and deploying a commercial satellite navigation system that does more things that is not serviced by the sort of traditional GPS and other systems that exist today. So to give a bit of background on the kind of GPS system, this is really Cold War design infrastructure. It was designed in the 1960s, 1970s, deployed in the 1990s, and now we have a system in place that has really led to widespread distribution of navigation, really bringing it to the masses. But we now find ourselves in a world where the commercial world is asking for more out of GPS than what's available today, and that's where Pulsar comes in.
Okay, and I just want to clarify on what will you be doing with the National Research Council? What's the tie-in there with that? I'm just trying to clarify for myself.
Absolutely. So our announcement today with ISED, so the Innovation, Science and Economic Development Canada, in partnership with the National Research Council, with funding support from DRDC, Defence Research Development Canada, is really about being able to distribute this Canada source of time through that system. And so this is to give traceability not just to U.S. or European sources of time, but also to Canada's source of time through this commercial system. And so this is all about showcasing that in places, not just in kind of the major cities, but also in places like the Arctic as well.
And how close to reality is this? Are we getting close to having our own time, so to speak? It sounds funny saying that.
So today, Pulsar has deployed our first production class satellite. So we launched that about a year ago. And so we've been operating that in more than 10 countries. We have more than a dozen partners that have been tracking the satellite in a multitude of applications. And so this is including trials in the Arctic. And so this is already a reality here today with that satellite. And so this gives us yet another platform to show that integration of what's possible with the full constellation, which will be launching more satellites in the coming years.
And what are some of the challenges for the trials up in the Arctic?
In the Arctic today, one of the big challenges is that GPS was not designed for the Arctic. It was designed to service the mid-latitudes, and so the major cities. And so that means that north of Edmonton, we don't have satellites overhead anymore, which leads to a lot of degradation in the service in the Arctic. And this is well known among mariners as well as the aviation community at large. And so this really gives an opportunity to bring better coverage to the Arctic, to service Arctic communities, but also to the emerging seaways that are opening up in the Arctic as well.
All right, and we're out of time, but just one last quick question. Private company now, any thoughts on an IPO?
We're a venture-backed company today, so we raised our Series C, which is a $170 million round just a few months ago. We still have some milestones to hit, and so but we're moving forward, and it allows us to expand in places like Canada towards that mission.
All right, Tyler, thank you very much for joining us today. We appreciate it.
Thank you.
Tyler Reed, co-founder and CTO of Zona Space Systems. Up next, from AI breakthroughs to a community-driven surge in innovation, Toronto Tech Week is showcasing how the city is redefining its role on the global tech stage. More on that next. While Toronto is strengthening its position as a global innovation hub, with Toronto Tech Week uniting founders, investors, and operators amid discussions on AI, global scaling, and talent. For more on this, we spoke to the co-founding partners and co-directors of Toronto Tech Week, Melanie Trung and Julia Knafel.
Community-led series of events put on by over 600 community hosts, organizations, small and large, who are opening their doors and showcasing Canadian innovation and talent all across the city. It's a citywide takeover this week.
Yeah, great that you guys are doing this. I mean, I'm curious to hear just stuff from the investor side. Are there a lot of VC funds in town? Are there a lot of deals getting done and companies raising capital? What's that sort of environment like around this week?
Yeah, absolutely. We have investors flying in from across the globe for Toronto Tech Week, which is really exciting. We also have investors from across the country in, and there's a lot of really exciting events. There's a lot of reverse pitch competitions, actually. So if founders are looking to fundraise, they can go and learn from investors directly. And equally, investors are here looking for deal flow. There's so many incredible companies, new startups, scale-ups, like there's really something for everyone. So whether you're an early stage founder or an early stage investor, there's events and opportunities for you, but also for growth stage companies as well. So we're seeing a lot of investor interest from across the globe for this week.
I wanted to ask about that because there was just a report that came out about how different cities in the country are managing to move away from the U.S. and Toronto is one of the more successful cities. Is it being driven by tech and AI? Then you mentioned all these people coming in from around the globe. Are we succeeding in that sector, in the tech sector?
Yeah, I think, great things happen when smart people are in the same room. And so there's a real opportunity for Canadian companies to raise from, other Canadian investors at Toronto Tech Week specifically. And there's so much interest in AI right now. I'm sure you guys have been talking about it a lot. And those are a lot of the conversations that are happening at Toronto Tech Week. About 60% of events that are happening involve something about AI. And so it's obviously such a hot topic and a top of mind for investors and founders equally. And so our hope is that by bringing people together, we'll be able to, help with deal flow, help deals get done, help founders fundraise, help talent find new roles at startups within the ecosystem. So our hope is that it's fruitful for everyone that's joining.
And how is AI changing the narrative around software? I know in the public markets, that's been a big concern as far as disruption around software companies. But for a long time, software businesses had been pretty hot, and I think raising a lot of capital from VC and growth funds. I mean, are there software companies that are participating, or is that less of a focus, I presume, this year?
There's still a ton of software companies that are participating this year, like large software companies. And so, things are changing rapidly, but these companies are obviously still exist and play such an important part in our ecosystem as well. And they're changing and they're adopting, new AI practices as well. And there's still a lot of involvement, but we're also seeing some really exciting new tech and AI companies come forward that are brand new startups and that are building and raising during this week.
And is there one subsector that's kind of standing out this year where you're seeing more interest or more founders showing up for that subsector?
I mean, there's so much that's happening.
Yeah, I wouldn't say that there's one sector that's showing up more. I mean, this Toronto Tech Week is an open platform for anyone and everyone to get involved. And so we are seeing a huge diversity across all sectors, industries, even like hospitality groups also. So Toronto Tech Week really is a citywide takeover. Whether you're in tech, you're wanting to get into tech, there's so much happening. And so I think there's a pretty nice and diverse set of events happening across all industries and sectors this year.
Yeah, I will say too, there's actually been a lot of hardware tech companies. And I think that's been really interesting. I think we were all, really ready for a lot of AI events and topics. But hardware has been a big part of Toronto Tech Week this year. And so it's been really cool to see the robotics community come into play. And that's been really exciting for us to see.
And as part of the idea behind what you guys are doing with this conference to sort of just spur more innovation in the Toronto tech community, and is that like, are you seeing that sort of behind the scenes with new companies starting in Toronto and sort of a growing community of AI innovation and things like that?
Yeah, well, Toronto already has one of the most vibrant tech ecosystems in the world. And so, but what it didn't have was really a shared moment where the ecosystem could come together and showcase what's being built here. And so really, this is an opportunity for founders, investors, operators, researchers, students, global technology leaders to connect across the city and really highlight the scale of innovation happening in Canada.
And are you seeing results? And the big concern, I think, there was also an article I saw this week about the brain drain. Are you finding Canadians, specifically people from Toronto, are staying in Toronto, or is that the legitimate? They get some funding, they get some success, and they head south usually?
Yeah, well, part of the reason why Toronto Tech Week was started was actually to address the brain drain specifically amongst our younger talent pool. And so it's really important to us that we show young people what great looks like and that they can build successful and fruitful careers and companies in Canada. And so what's been really exciting for us this year is seeing so much student and university involvement this year and seeing a lot of young founders come out of that as well. We actually started a student ambassador program with university representatives from across, the major universities across Ontario. And they've been instrumental in bringing young people into the fold. And so our hope is that by, bringing them into the same rooms as these incredible leaders, that they'll be able to understand that they can build fruitful companies here. And if they are building, then hopefully we're helping them find investment, talent, or, clients as well.
And it's such a great question because companies like Shopify and Cohere have shown that globally relevant companies can be built from Canada. So one of the most important conversations right now is how Canada continues to retain top talent while creating an environment where founders can scale ambitious companies here long term. So.
And are you working at all with any of the sort of the faculty of some of the leading universities here, whether it's U of T or Waterloo, to, where there's been a history of tech and innovation? And are they involved in the conference, or are there programs sort of starting to focus on AI and things like that?
Yeah, we were actually both just at U of T yesterday. So Reynolds Zinn of Databricks and Mike Murchison of Ada were speaking about like the future of AI and building, $100 billion company brick by brick. U of T has been instrumental in Toronto Tech Week. They've really taken it and ran with it, which has been awesome to see. But we've also seen involvement from McMaster, Waterloo, McGill, even TMU. So many universities have been involved as well in getting their young folks involved.
All right, that was co-founding partners and co-directors of Toronto Tech Week, Mel Trung and Julia Knaffel. Let's take a look at how the markets are faring right now, and we'll start with Wall Street. And after a nice run, it's been a little bit of a calm down, a little breather. You can see the S&P 500 off the highs from yesterday, down by 0.19%. The NASDAQ, it is also off from its high yesterday, down by 0.38%. One company worth mentioning, Micron Technology. Take a look at what it's doing right now. And it has been on a tear. Look at the 1 year, 862%. It crossed the $1 trillion valuation line. Happened yesterday. I was joined today by SK Hynix. It has been just explosive. And you can see it is carrying through again today. It's even up today, even with the NASDAQ off slightly. And it's showing no signs of letting up when it comes to chips. Heading to Bay Street now. And Bay Street, off day, 0.3. It's off right by now. It's been clawing back a little, but now it's slipped a little. And you can see being dragged down mostly by healthcare and materials. But a couple of note, Air Canada was getting a boost earlier. A lot of the airlines seeing a bump, and Air Canada doing the same today. It's up by 2.54%. And another one I want to talk about, MDA Space. It has been on a rocket ride. The SpaceX IPO announcement has really fueled it, but it since in the last month, it's up by about 50%, maybe even 60%. I'm just doing really quick math. Around April 29th, it was sitting at 39, and it's up around 64.78 right now. Coming up, don't miss my interview with Alberta Premier Daniel Smith today on Trading Day. Tune in at 1:40 Eastern, 11:40 Mountain. And market calls up next. Mike Philbrook, CEO of Resolve Asset Management, will be taking your questions on ETFs. Thanks for watching Morning Markets. We'll see you back here tomorrow.